debt, the Canadian mortgage story. In recent years, the financial landscape for many Canadian families has become increasingly precarious. Canadian households are heavily indebted. The dream of home ownership has led many to take on significant financial burdens. Much of this debt stems from mortgages. With housing prices soaring, families are stretching their finances to the limit to secure a place to call home. The average Canadian owes more than twice their disposable income. This means that for every dollar earned, more than $2 are owed. This is a worrying trend. Financial experts are sounding the alarm, warning that such high levels of debt are unsustainable. It mirrors the conditions leading up to the 2008 financial crisis in the United States. Back then, the housing market seemed invincible. Back then, American homeowners took on massive mortgages. They believed that the value of their homes would continue to rise indefinitely. They assumed housing prices would keep rising. This assumption led to risky financial behavior and over-leveraging. When the bubble burst, many faced foreclosure. Families lost their homes and the economy was thrown into turmoil. Could this happen in Canada? The similarities are striking and the potential consequences are dire. It's a question that's keeping economists up at night. They are closely monitoring the situation, hoping to prevent a similar crisis from unfolding on Canadian soil. Policymakers are also taking note. Measures are being discussed to cool the housing market and reduce household debt. Financial advisors are urging families to be cautious. They recommend creating a budget, reducing unnecessary expenses, and avoiding taking on more debt than necessary. Communities are coming together to discuss the issue. There is a growing awareness that collective action is needed to address the housing crisis. Despite the challenges, there is hope. With careful planning and responsible financial management, Canadian families can navigate these turbulent times and secure a stable future. Echoes of 2008. A housing bubble north of the border. Several factors point to a potential housing bubble in Canada. Low interest rates for over a decade fueled demand. People rushed to buy homes, driving up prices. This created a sense that real estate was a surefire investment. However, with rising interest rates, the tide is turning. Affordability is declining, and some homeowners are struggling. The situation is reminiscent of the pre-2008 US housing market, raising concerns about a potential crash. Fueling the fire, insecure lending practices. Insecure lending practices have exacerbated the problem. To qualify for larger mortgages, borrowers were encouraged to take on longer amortization periods. Some even stretched beyond the traditional 25-year limit. While this might seem appealing initially, it comes with significant risks. Borrowers end up paying more interest over the life of the loan. They are also more vulnerable to interest rate hikes. The amortization trap, a long road to ownership. Extended amortization periods exceeding 25 years have become increasingly common. While they might seem like a good idea to enter the housing market, they pose significant risks. Borrowers end up paying considerably more interest over the extended loan term. This eats into disposable income and makes it harder to manage other financial obligations. It can also create a false sense of affordability, leading borrowers to take on more debt than they can handle. Section 5. Banks at risk, the perils of extended amortization. Extended amortization periods pose risks not just to borrowers but also to banks. When borrowers have stretched out loans, they're more vulnerable to economic downturns. Job losses or unexpected expenses can lead to defaults. This puts banks in a precarious position. They could face significant losses if many borrowers default on their mortgages. The situation highlights the need for stricter lending standards and greater awareness about the risks of extended amortization. Section 6. TD Bank in the spotlight, money laundering allegations and financial stability. TD Bank, one of Canada's largest banks, faces scrutiny for potential money laundering violations. These allegations have put the bank under intense public and regulatory scrutiny, raising questions about its internal controls and compliance mechanisms. This comes at a time when the bank is already grappling with the challenges of a potentially overheated housing market. The Canadian housing market has seen unprecedented growth with soaring property prices and increased borrowing, which has put additional pressure on financial institutions like TD Bank. The allegations, if proven true, could result in hefty fines and damage the bank's reputation. Such financial penalties could be substantial, potentially running into millions of dollars, and the reputational damage could erode customer trust and investor confidence. This could further destabilize the financial system, already under stress from high household debt levels. Canadian households are among the most indebted in the world, and any instability in major banks could exacerbate financial vulnerabilities, leading to broader economic repercussions. The outcome of these investigations will have significant implications for TD Bank and the broader Canadian financial sector. Regulatory bodies are closely monitoring the situation, and the findings could lead to stricter regulations and oversight for the banking industry as a whole. Financial analysts are keenly observing the developments, as the results could influence market dynamics and investor strategies. Investors are particularly concerned about the potential impact on TD Bank's stock performance. Any negative findings could lead to a decline in stock prices, affecting not only the bank's valuation but also the portfolios of countless investors. Customers, too, are watching closely, as the bank's ability to maintain its services and customer relations could be affected. Trust in the banking system is paramount, and any erosion of this trust could lead to a shift in customer behavior, with potential withdrawals and a move to other financial institutions. Government officials may also respond with new policies aimed at preventing such issues in the future. This could include more stringent anti-money laundering regulations and enhanced oversight of financial institutions to ensure compliance and protect the integrity of the financial system. The ripple effects of these allegations could extend beyond the financial sector, impacting local communities and economic activities. Small businesses and local economies that rely on stable banking services could face challenges if the bank's operations are disrupted. As the investigations continue, all eyes remain on TD Bank and the broader implications for financial stability in Canada. The outcome will not only shape the future of one of the country's largest banks, but also influence the regulatory landscape and economic health of the nation. Section 7. Systemic risk money laundering and the Canadian banking sector. The potential for money laundering penalties extends beyond TD Bank. Several Canadian financial institutions are under investigation. If found guilty, these institutions could face substantial fines and reputational damage. This raises concerns about the stability of the Canadian banking system. Money laundering undermines the integrity of financial institutions. It erodes public trust and can have a ripple effect throughout the economy. Section 8. The mortgage squeeze, rising rates and negative amortization. Canadian mortgage holders are facing a double whammy: rising interest rates and negative amortization. As rates climb, mortgage payments increase, putting a strain on household budgets. Negative amortization occurs when monthly payments don't cover the interest accrued. This means the principal amount of the loan grows, trapping borrowers in a cycle of debt. The combination of these factors is creating a precarious situation for many homeowners. Section 9. The perfect storm: inflation, stagnant wages and mounting debt. The challenges facing Canadian mortgage holders are compounded by inflation and stagnant wage growth. The cost of living is rising, eroding purchasing power and making it harder for households to make ends meet. At the same time, wages haven't kept pace with inflation, further squeezing household budgets. This combination of factors is creating a perfect storm, making it increasingly difficult for Canadians to manage their debt loads. Section 10. Regulatory inaction. A recipe for disaster. Critics argue that regulatory inaction has contributed to the current mortgage crisis. They point to the lack of oversight in lending practices and the failure to address the risks of extended amortization. Some call for stricter regulations to prevent a repeat of the 2008 financial crisis. They argue that proactive measures are needed to protect borrowers and ensure the stability of the financial system. Section 11. A glimmer of hope: potential interest rate trends. There are whispers of potential interest rate decreases in the future. Some economists predict rates could fall to 4.5% in the coming years. This could provide some relief to mortgage holders struggling with high monthly payments. However, it's important to note that this is just a prediction. Economic conditions can change rapidly, and there is no guarantee that rates will actually decline. Section 12, Conclusion: Navigating the uncertain waters of the Canadian mortgage market. The Canadian mortgage market is at a crossroads, with the economy facing numerous challenges. The landscape for home buyers and investors is becoming increasingly complex. High household debt, rising interest rates, and the potential for a housing market correction pose significant risks. Many Canadians are finding it difficult to balance their financial obligations, and the dream of home ownership is becoming more elusive for some. While there is no crystal ball to predict the future, it's clear that action is needed. Financial experts suggest that both borrowers and lenders need to adopt more cautious strategies to navigate these uncertain times. Borrowers need to be aware of the risks associated with high debt loads and extended amortization periods. It's crucial for families to have a clear understanding of their financial situation and to seek professional advice when necessary. Banks need to exercise prudence in their lending practices. This means conducting thorough assessments of borrowers' ability to repay loans and avoiding overly aggressive lending strategies that could lead to defaults. And regulators need to step up and ensure the stability of the financial system. This involves implementing policies that protect consumers and maintain the integrity of the housing market. The decisions made in the coming months and years will have a lasting impact on the Canadian economy. It's a collective effort that requires the cooperation of all stakeholders, including government bodies, financial institutions, and the public. Despite the challenges, there is hope. Communities across Canada are resilient, and with the right measures in place, the housing market can stabilize and even thrive. Families can still achieve their dreams of home ownership, and investors can find opportunities in a well-regulated market. Staying informed is key. Canadians should keep abreast of the latest developments in the mortgage market and seek advice from trusted financial advisors. Knowledge is power, and being well-informed can help individuals make sound financial decisions. Financial literacy is more important than ever. Educating the younger generation about money management and the implications of borrowing can pave the way for a more financially secure future. Policymakers also have a role to play. By enacting supportive housing policies and ensuring that the financial system remains robust, they can help mitigate risks and promote stability. In conclusion, navigating the uncertain waters of the Canadian mortgage market requires vigilance, cooperation, and proactive measures. By working together, Canadians can overcome these challenges and build a prosperous future for all.